Hi, my name is Alexa, and my group is going to be discussing investing in hedge funds and ETFs as an individual, including returns and risks. Here's our team. Why is pooled investing important? Well, this can help you know which type of investments to put your money in, which will save you both time and earn you money for the future. Pooled investing also offers diversification benefits as opposed to investing in an individual stock and gives you more options to lower or increase risk or returns depending on the type of portfolio you are trying to build. What is an ETF? An ETF is an exchange pooled fund. An ETF pools a group of securities, commodities, or stocks into an investment fund. These funds usually follow specific sectors like tech or healthcare, or an index like the S&P 500. ETFs are traded like individual stocks on an exchange throughout the day. They trade at the market-determined prices, and they use real-time pricing. Therefore, the price you pay is based on when you purchase the ETF. ETFs are also highly liquid and low cost. For example, if you bought Vanguard's S&P 500 ETF, for $5,000, you pay $5,000 and receive a proportional share of the entire index, which is made up of 500 companies. You, as an investor, gain a diversified portfolio and you receive yearly dividends while your investment grows. If you had invested $5,000 10 years ago without any dividend reinvestment, the average return since then has been 14.6%, and today you would have $19,552. ETFs are created by registering with the SEC as open-ended funds, which is a type of investment management company. An open-ended fund is an investment vehicle that creates and redeems shares based on investor demand with no fixed share limit. A very small percentage of ETFs are not registered and are instead regulated by the Securities Act of 1933. This includes certain commodity, currency, or future-based ETFs. The SEC recently blocked ETFs that were designed to deliver 3 to 5 times the returns because they exceeded the risk limits set out by Rule 18F, which blocks the value at risk of an ETF at 200%. ETFs are so popular because they're cost-effective. Unlike mutual funds, ETFs offer a lower-cost alternative and require very small minimum investments, usually a share, or at Vanguard, it's as low as $1. The fees associated are typically very small. For passive ETFs, this is under 0.01%. For actives, this is under a percentage point. ETFs are also overseen by a portfolio manager. So in a passive ETF, this means the manager ensures stocks are held by a weight similar to their index. And in an active ETF, the manager uses their discretion to add or remove stocks. ETFs also offer diversification benefits. They include hundreds of stocks, which reduce the impact of a security's bad performance. If one stock in the portfolio is doing poorly, typically another is doing well, which will offset the loss and stabilize your portfolio. Additionally, ETFs are pretty tax efficient. They're sold between investors, but the actual stocks remained owned by authorized participants. Therefore, trading activity is typically lower, and capital gains are only recognized for sales and dividends received. Some types of ETFs that are passive include full replication, where the ETF holds all the stocks and bonds within the index in the exact same proportion; sampling, where the ETF holds a representative sample of the securities in the index. This is typically used for bond ETFs; or synthetic replication, which uses derivative contracts, swaps, to replicate the return of an index instead of buying the actual securities. Active ETFs include fundamental, where a manager analyzes the securities with fundamental research, including financial statements, earnings, and growth, to select securities they believe will outperform the market. Factor-based, which is selecting securities based on characteristics associated with high returns; or tactical asset allocation, where managers actively adjust the portfolio across regions or asset classes depending on market conditions. The value at risk calculation for an ETF is used to find the maximum expected loss of an investment over a set period at a set confidence level, which is typically 95%. Usually, you use the historical method to calculate this, and you arrange the daily returns in order from worst to best using 1 year of data. Then you find the 5th percentile value of the data, or the nth worst loss, and you multiply the portfolio value by the worst loss that can be expected. For example, in a portfolio worth $100,000, You use the fifth percentile to find the rank of the worst loss. In this case, it would be the 19th value. You would look at your 19th worst loss, which in this case is negative 6.5%, multiply that by the portfolio value to get negative $6,500. That means there's a 95% confidence that the portfolio will not lose more than $6,500 in a day.
So how investor actually makes money from the ETFs? Um, but there's two main sources of ETF returns. The first is capital appreciation, and the second is the dividends. So if the underlying index increase, the ETF price actually rise as well. At the same time, when it comes to ETF pay dividends, which are passed to on individual investors. So the total return comes from both price growth and dividends. And for example, the S&P 500 has historically returned about 10% annually, and meaning a 10,000 investment could grow to around 67,000 over 20 years due to the compounding. And let's look at some real example uh, for ETF investments. The first is VOO, the Vanguard S&P 500 ETF. VO tracks the S&P 500 index. So is what investor can get exposed to 500 large US company like Apple, Microsoft, and Amazon. And it provides broad diversification and have a very low expense ratio, about 0.03%, which is very important. And because of this, VO is widely used in long-term investment portfolio, especially for retirement investing, like 401k. Yeah, these two are the capital appreciation and dividends income for the VO in past 5 years. Um, and there's another major ETF is SPY, which also tracks the S&P 500. And SPY was the first ETF launched in 1993 and remain one of the most active trade ETF today. Like VO, it provides exposure to the same 500 company, but it has a high expense ratio, about 0.0945%, and and also have a higher liquidity. And even though they track the same index, they're used differently by investors. So if both ETF track the same index, why do so many long-term investors prefer VO instead of SPY? There's two main reasons. The first is the fund structure. VO is an open-ended ETF, which is more flexible and efficient. And SPY is a unit investment trust, which is the older structure with the same limitation. The second is how investors use them. VO is preferred by long-term investor because it's low cost. Even small fee difference can have a big impact over time due to compounding. And SPY, on the other hand, extremely liquid and widely used by trader for short-term trading. So in practice, VO is mainly for long-term investing, while SPY is often used for trading. And why ETF are so powerful tools in international investments. Um, from my own experience growing up in China, many investors interested in the US market in the past few decades, especially companies like Apple and Nvidia, because they heard so many news about it and they like the paper is doing so well. Um, it's like compared to the Chinese stocks. However, investing directly in US stocks can become complicated. It requires opening a foreign account, and transferring funds and managing exchange fees. In addition, Chinese residents can only convert up to 50K per year into foreign currency, which can be limit large investments. Because of this, ETF provides us a simple solution. Instead of buying individual stocks, investor can just buy an ETF like S&P 500 or NASDAQ 100 and get exposed to the hundreds companies. And ETFs can also provide Currency diversification, since investors are directly exposed to US dollar assets, and that's why ETF are widely used in global investing. While ETF have many advantages, there are still few risks. The first is the market risk, since ETF move with the overall market. So if S&P 500 declines, the ETF tracks the index will also fall. And second is the tracking error, means the ETF may not perfectly match the index. It might because of the percentage in the ETF for different companies, and there's also management fees and trading costs. Like VO got 0.003, but SPY got 0.945. It's a huge gap. And third is the liquidity risk, especially for smaller and specialized ETF. Um, it might not be that liquid like VO and SPY. So overall, the investor should understand these risks while using ETFs.
First, what exactly is a hedge fund? A hedge fund is a privately managed investment fund that pools money from investors and uses advanced strategies to generate returns. Unlike ETFs or mutual funds, hedge funds are actively managed and do not have to follow a specific market index. Because of this flexibility, managers can use strategies like short selling, leverage, derivatives, and arbitrage to try to make money in different market conditions. The main goal of most hedge funds is to generate what's called alpha, which means earning returns that outperform the overall market. So the key idea here is that hedge funds are private, actively managed, and designed to beat the market using more complex strategies. Next, I'll go over some common hedge fund strategies. Hedge funds use a variety of strategies to generate returns, and many of them try to make money whether the market is going up or down. One common strategy is long short equity, where managers buy undervalued stocks and short overvalued ones. Another is global macro, where investments are based on large economic trends like interest rates, inflation, or currency changes. There are also arbitrage strategies where managers try to profit from small price differences between related securities. Another important category is event-driven strategies, where investments are based on corporate events like mergers or acquisitions. For example, a hedge fund might buy shares of a company being acquired while shorting the acquiring company to profit from the expected price difference. Who invests in hedge funds? Hedge funds are usually limited to accredited investors because they involve higher risk, more complex strategies, and less regulation than traditional investment funds. The SEC defines an accredited investor as someone with a high net worth or high income. Typically, this means at least $1 million in net worth, excluding the primary residence, or about $200,000 in annual income. Many hedge funds also require large minimum investments, often between $200,000 to $1 million. Because of these requirements, hedge funds are typically used by wealthy individuals, institutional investors, pension funds, and university endowments rather than a typical retail investor like us as college students. Hedge fund fee structure. One major difference between hedge funds and ETFs are the fee structures. Hedge funds typically charge both a management fee and a performance fee. The management fee is usually around 2% of assets per year, and the performance fee is often around 20% of profits. For example, if someone invests $100,000 and earns 10%, the hedge fund may take $2,000 as a management fee and then another $2,000 as a performance fee. This means the investor only keeps about $6,000 in profit. In comparison, ETFs usually charge very low fees, often less than 0.1% per year. Because of this, fees can significantly reduce your returns over long periods of time, especially with hedge funds. To summarize, hedge funds are actively managed investment partnerships that try to generate returns using advanced strategies not typically available in ETFs or mutual funds. Managers may use long, short equity, macro trading, or event-driven strategies to try to outperform the market. Some potential advantages include the opportunity to generate higher returns, access to alternative strategies, and diversification from your typical investments. However, there are also some important risks. Hedge funds usually have higher fees, lower liquidity than ETFs, and performance depends heavily on the skill of the manager and the firm that it's with. Because of these factors, hedge funds are usually used by high net worth or institutional investors, while most individual investors use ETFs as their main investment vehicle. So the main takeaway is that hedge funds offer more flexibility and potential return, but they can also come with higher risk, higher fees, and more restrictions.
Hi, my name is Munir, and now I'm going to talk about hedge fund returns and risks, focusing on how they perform and what investors need to consider before investing. So, hedge funds aim to generate what's called alpha, which means returns above the overall market. Unlike EFTs, they use active strategies like long and short positions, meaning they can bet on stocks going up or down. They also use things like global macro strategies and event-driven investing. Because of this, hedge funds can potentially make money in both rising and falling markets. However, an important thing to understand is that returns depend heavily on the skill of the fund manager, not just the market itself. Historically, hedge funds return around 6 to 10% annually. This is similar or sometimes lower than the overall stock market like the S&P 500. In strong bull markets, hedge funds often underperform because they are more conservative, but in downturns or volatile markets, they tend to perform better because they are designed to reduce risk. So overall, hedge funds focus on more consistent risk-adjusted returns rather than maximizing growth. Even though hedge funds sound attractive, they come with significant risks. As you can see in the slide, here's the risk. First, there's market risk, where strategies may fail. Second, leverage risk, since borrowing money can amplify losses. There's also manager risk, making performance depend heavily on the decisions of the fund manager. And finally, there's limited transparency, so investors may not fully understand what the fund is doing. Because of these factors, hedge funds can be unpredictable. Another important downside is the liquidity risk. Unlike EFTs, you can't just sell your investment anytime. Hedge funds often lock up periods, making your money tied up for months or even sometimes years. This limits flexibility and makes it harder for investors to react to market changes. As you can see on the chart on the right, it says cash versus liquidity and it shows why they are not the same and the differences between the two. Sorry, I'll move my camera. Right there, you can see the whole chart. Hedge funds also are very high, often called the 2 and 20 structures, their fees. This means 2% management fee plus 20% of any profits. So even if the funds are performing with a large portion of gains, so even if the funds are performing well, a large portion of gains goes to the manager. These fees significantly reduce what the investor actually earns. To show how powerful these fees are, here's a simple example. If you invest 100,000 and earn 10% per year, without fees, you would have about 259,000 after 10 years. But with hedge fund fees, your return drops to around 6 to 7%, leaving you with about 196,000. That's over 60,000 loss just from fees. This shows how even small percentage of fees can have a huge impact over time. And here are the advantages and disadvantages from the hedge fund trade-offs. And to summarize, hedge funds offer potential advantages like diversification and the ability to generate alpha. However, they also come with major downsides, including high fees, low liquidity, and higher risks. And overall, hedge funds use sophisticated strategies, but for many investors, the cost and risk often outweigh the benefits.
Hello, class. My name is Charlie Bear, and I will be giving you right now a side-by-side comparison between ETFs and hedge funds. So on the left, you could see, as my group mates were saying earlier, ETFs are traded on a stock exchange. They are liquid. They are available for retail investors. There is no minimum, so anyone can get in at any price that they would like. It typically is passive and follows a sector or an index, and the returns typically reflect the market, and there are very low fees. Whereas on the right-hand side, you see hedge funds are a private investment fund. There is very limited liquidity. It is available only for accredited investors. There is a very high minimum interest payment, which is typically $250,000. It is actively managed, which means that it tries to beat the market and have an alpha. And then there are very high fees, which is usually 2% for management and 20% in return. So why choose an ETF? So people have a desire for certain sectors, such as tech or healthcare, and they could find an ETF that has all the biggest stocks for that. And it could also follow an index. It's easier to trade, such as the SPY, if you want to buy the S&P 500. And then there's no minimum, so you could get it for any price. And then it still mostly reflects the market trends, which people will be going for. And then it is perfect for students like us who have very little money, really, and time in the workforce to be building up actual wealth. And as you can see on the right, liquidity, low fees, and follows market. And then why would you choose a hedge fund? So it displays a greater upside because the end goal is to beat the market. So you're trying to have more upside than if you were just to invest in the S&P 500. It covers many different sectors and investment options in one. So when I said if you want to buy an ETF for tech, well, there's probably tech, healthcare, and like anything you could think of in a hedge fund. And it is only for accredited investors who have enough money to buy into this fund because you have to have at least $250,000 to not like give away, but to give to them to invest and not really see for a little while. And on the right, you can see that it's actively managed. So whenever the market's in a downturn, they'll try to hedge your money and go down not as much as the market. And whenever the market is booming, they take it a little riskier and they want to invest to make more. And then it's diversified. So it covers a broader market and at the bottom is risk tolerant. So if you want to get into a hedge fund, you got to be risk tolerant because you might be down a good bit of money because it's a lot more volatile than the market. So in conclusion, ETFs are accessible, low-costing investment strategies for everybody. Meanwhile, hedge funds are a high-risk, high-reward investment strategy that is exclusive. So thank you very much for listening. I hope this gave you a clear understanding of the difference between ETFs and hedge funds, and we will hear you out on whatever questions you guys may have. And the link is here for the quiz. Thank you.